Hello, everyone. I am going to pause for a second and let everybody go ahead and get into the webinar from the waiting room. Plus, it looks like we have a bunch of people that are joining here at the last second, just because it is right now noon. So I'll give it just a couple seconds here. All right. That looks good. Looks like everyone made it. So welcome everybody to this awesome presentation, right, about cash flow and budgeting. Thank you to Community Ventures for offering to present this to business owners within the state of Kentucky. Obviously, if you are not from Kentucky, we welcome you as well. But this is specifically because of Community Ventures. It's based in the state of Kentucky. My name is Christy Dudgeon. I am the president of SBC. We are a bookkeeping and consulting firm. We're actually based in Ohio. We provide clarity and confidence to businesses throughout the country. We put on numerous workshops just like this across the country, as well as work one-on-one through different programs that partners may have, as well as one-on-one directly with businesses. Feel free to connect with me on LinkedIn. Also, our LinkedIn page is there as well. All right, we're going to jump right into it. We have quite a bit of information here for the next hour. I will try to leave time at the very end for questions as well. In the meantime, before the end, if you do have a question, the Q&A is open. You can drop your questions in there. I may just see them as I'm talking and I may respond to you, certainly if it's relevant with what we're talking about right then. I'll try to catch it. If I don't, I will go back through all of those at the end and try to catch them as well. So if I don't have an answer for something as well, I can help follow up with that at the end of the workshop. So I have the first poll that is open. So if you guys can find the poll, we're going to have several poll questions that you guys can participate in. Looks like quite a few of you have already found it. So this is just for me to understand where everybody is with everything. And it looks like we have a pretty good mix. So we've got some growth stage, we've got pre-venture, and we've got a few startups in here as well. And I'll share these results as we go through it so that you guys can also see kind of where the participants are today. So we are talking about cash flow and budgeting. So cash flow is the first part of our conversation. Budgeting will be the second. So cash flow, this is, when I speak of cash flow, this is our money coming in minus our money going out, right? That's the very simplified way to talk about cash flow. Money coming in can be from a lot of sources, but for the majority of businesses, it's probably our sales, right? Cash received from customers. We might have applied for a loan and received loan funds of some sort, and we also might be contributing our own money. So there's also investments that can be in there, things of that nature. So depending on where you are in your business phase, money coming in can look like a lot of different things, but typically that really is just sales or owner contributions for our startups or our pre-ventures. Money going out, these are things that are operating expenses. Maybe this is payroll. These are our debt payments. So if we do have those loans, equipment purchases, maybe we're going to make a capital purchase, right? And buy something with the cash that our business has. It also can be the taxes that we pay and numerous things. So basically anything that is money going out, we have to have visibility to that and awareness. So a key concept here is that profit does not equal cash. You will hear me say this several times. And then I also have a poll question that is going to be around this. So look for that right here. Has your business been profitable, but you were still short on cash? Give me a second to switch my poll since I am single working this show today. There we go, cash flow. All right. Has your business been profitable, but you were still short on cash? And I'll give you a second to go ahead and answer that one. Got a few people saying no. Majority of people, though, it looks like, are saying yes. So I'll leave that open for a second while everyone is still answering it, and then I'll share those results with you guys. So if you answered yes to this question, then you have a cash flow issue. This is very common, especially when we're first starting out. Maybe we don't understand our financial statements, or maybe we only have visibility to our financial statements, but not necessarily understand what cash flow is or kind of how that money is moving. There could be a number of reasons we have cash flow issues. We might be just looking at our bank account and say, okay, we've got money in there, I'm going to go spend it, right? And we don't have that future looking opinion or information about what our business is able to actually spend. We also could have customers that are paying late. So maybe we invoiced somebody and we just haven't received those payments yet, or as we were expecting to receive them. So definitely late customer payments can throw cash flow all over the place. I owned a small business when I was very young, early starting out, and I had late customer payments happening all the time, right? So we spend a lot of time chasing down the money, and that's so that we can meet our debt obligations or our bill obligations. Seasonal fluctuations. If you're in the type of business where maybe you are controlled by the weather, right? So I speak of this from being in the landscaping background that I've had. The weather dictated what we were able to do. We had snow removal. We had very busy seasons such as the spring, right? The summer usually goes down, fall gets a little greater. And so we could have a lot of seasonal fluctuations as far as where money was coming in and money was going out. If you're in the agriculture world, right, this can happen too as well. You might only receive money one time of year, and that's when you're harvesting. It really depends on where you are. Those that depend heavily from the retail segment, less chaotic. Also, large annual expenses. Definitely for those businesses in retail that I was just talking about that might have those later season sales. You might need to buy your inventory though to get the best pricing earlier in the season as opposed to waiting until that extremely busy season, right? So looking at when you can actually make those large annual purchases and what that's going to do to your cash flow as well. Inventory, I mentioned, unexpected repairs. Oh my gosh, we can plan for everything. We can't plan for all of it, right? That's really how it happens. Unexpected items come up all the time. That's why when we start to talk about budgeting, having that contingency plan or something built into our budget is really going to help us prepare for that. And then tax payments, man, this one gets so many small businesses. And maybe it's because we don't know what our tax bills are going to be, or we really don't understand enough yet about what those taxes are. And it can be something as simple as sales tax collection, because we suddenly are looking at just our bank account, right? And we're looking at our number there and we say, oh, we've got money. And so we're paying our bills. And then we realize we have to pay sales tax. And that's one of those reasons that I usually recommend that you keep your sales tax separate from your main bank account, because otherwise it really does make you think that you have money that you truly don't have. You really were just keeping it for the state, and then you're going to pay it back at a later date, right? So taxes can really be one of those problems. But obviously, in the beginning of the year, I see a lot of businesses aren't sure what their business tax requirements may be, and so they didn't adequately plan for it right around that April timeframe, right? So cash flow tells us if our business can survive. I mean, it truly does. If we are looking forward, I'm going to share those results of that poll just so you can see where everybody is. So we have a lot of people that have cash flow issues, which is obviously why you're here. This tells us if our business can survive. So if we're able to look forward and say, can we pay our bills when our bills are due? When is our money coming in, right? It's kind of almost looking at that crystal ball to be able to say, yes, we're able to do this. And that also tells us when we can buy something and when we shouldn't. Cash flow planning really is that visibility that's going to prevent the panic. I've lived in those situations before. I know what emergency loans look like. I've actually mortgaged my own house before, trying to make payroll. It's not necessarily because I didn't have visibility to cash flow. It's back to that late customer payment. If any of you guys were around in 2008 for the crash of the housing market, I was in commercial contracting at that point, and that is when the entire world stopped. Every general contractor out there stopped paying all of their subcontractors, one of which was me. And we had to figure out how to survive, right? Until some of those payments came in. They often, if they had 90-day terms, they ended up being 180 days or whatever it may be. And so a lot of small businesses went under during that time frame, unfortunately. Um, Cash flow is all about timing, though. So cash flow includes things, if you're familiar with your profit and loss report, and what you can do from your profit and loss and what you can see. Cash flow is going to show you the things that you can't see on your profit and loss report, because a financial statement is looking backwards. Cash flow is looking forwards. Now, we need both of them to understand what it is that's coming forward and kind of the nature of the business. However, that's where these two reports greatly differ from each other. So we're looking for those timing of those customer payments, as I mentioned. Those are those accounts receivable. And then bills that we owe our suppliers. So it's accounts payable, right? So that's the difference between receivables and payables, as well as our loan principal payments. When are those due, if we have those loans? And it's going to help us confidently answer, will I have enough money to pay my bills? So these are credit card payments, equipment purchases, right? Owner draws, paying our bills on time, inventory purchases, plan ahead so there's no surprises. I was just talking to a business the other day in the state of Pennsylvania. They're about a $3 million business, and they've never done cash flow planning. At this point, they've just been making it, which is what a lot of small businesses do, right? But that doesn't necessarily mean that we're able to build anything for the future. And we always have that feeling like, oh, the next late payment, right, is the one that's going to break us as a company. And part of the issue within that company, and I see this with quite a few, is that if you're using some kind of financial software like a QuickBooks or a Xero or one of those, and you have the ability within that software to actually enter your bills, and so you're going to put your bill is on this date and it's due at a later date, it's not actually being utilized. And so if you have that software already, building cash flow or having visibility to cash flow is much easier, because you've got the tools there that will actually create the report for you. However, if you don't use the tools that are actually in there, then it makes it much more difficult to create that statement. So, or that cash flow report, whichever terminology that you use there. All right, so what is a cash flow forecast, though, or a cash flow statement, as I keep talking about? It's a tool that's going to help you answer that question, right? Will I have enough to cover my bills? So it's that cash coming in, cash going out, and it equals your cash balance. So we've got a starting balance, which is basically the starting balance that's in our checking account when we start the report. And then we figure what our cash coming in is going to look like, our cash going out is going to look like, and then we see our ending balance. That balance may be positive or negative, right? And we may have to make adjustments. Obviously, within maybe the week or the month, however we're looking at it, there may be some non-negotiables in there, right? So like a loan payment is due on this date, we don't necessarily want to pay that late. Credit card, if we don't pay it on time, right, we pay interest for that. So there's always a cost to that. Vendors, if we don't pay them on time or within expectations, when we pick up the phone and ask for whatever it is we need in an emergency situation, they may not be as apt to talk to us. So as a business owner, we have to make a lot of decisions, right, and how we move the money out of our business based on what's coming in. So really, it is a planning tool. It's helping us to plan ahead and really stay prepared for these types of things. And we know what's coming forward, though. We may forget to put a couple things in there, but we learn this over time, right? So it's not a guess, it's not a wish, it's a prediction, not really a prediction of success. It is really just outlining all of these things that we know are coming forward and helps us be prepared. And ultimately, in the end, it really is telling us, can I buy something or can I spend more money now, or do I have to wait, right? So when it comes back to that, if I'm purchasing inventory, or maybe there's a great deal on something that I know I'm going to need. Example, I work with an HVAC company, and they buy bulk for the materials that they utilize to install the furnaces and the AC units, right? And they work for a very large home builder, so they're probably working on 50, 60 houses at one time. So it's a very replicatable process that they have from materials. And they have the opportunity periodically to buy entire, semi loads basically of the material that they use to install the ductwork in the houses. And so I actually heard them talking back and forth one day when they were going through their cash flow, which was pretty cool to be able to say, do we want to go ahead and buy this? Because if they bought it now, it's going to cover them for the next year. Basically, they're already planning their projects out, and it was a great deal on it. So obviously, that's going to help their gross margin. It's going to help their profitability. Now, if they didn't have the cash flow to support it, they would have said, nope, we can't do it, right? And they're just going to take what they would normally have from a margin standpoint or a profit standpoint. But being able to have that visibility help them make that decision instead of being like, oh yeah, that's a great deal, let's buy it now, and then find out they can't pay their loan obligations or whatever that may be in a week or two. Been in that situation. I actually had a boss buy a boat, a very large boat, very expensive boat, and he killed our cash flow. One, he shouldn't have been doing that because, it's the business, but as a business owner, sometimes you can do that, right? And you can take your owner's draw. However, he killed cash flow. We had inventory that we were trying to purchase, and it was a whole snafu. So, if you have someone who is working with you on the financial side of things, you probably should ask them if you have the cash to buy the boat before you decide to do that, just to make sure it wasn't allocated for something else. So the 4-part cash flow forecast looks like this. So step one, as I mentioned, you have your starting cash. So this is what your beginning bank balance is. Now, this can be, if you want to run this just off of an operating account, so maybe you've got a separate savings account that is kind of your overages or whatever that is, then absolutely keep that separate. If it's the tax account, you're probably going to put your taxes in here, or you're at least going to mention in here that you're going to be funding that tax account by a certain amount, right? So that would be money out. So starting cash, you would just need to make a decision of what accounts or what cash you're actually going to include in this. But typically it is that operating account where the money is coming in of and out of, right? Then we have the cash coming in. So what do we anticipate from a customer payment standpoint? So cash flow from a customer payment standpoint is a little easier to project when you are invoicing someone, because you actually are putting a timeline on when that money should be received, right? So if I'm invoicing someone today and they've got 30-day terms, then I could reasonably expect that they're going to pay in 30 days. So I can easily put that out 4 weeks from now and say that I'm expecting to receive that money. If you are a business that doesn't invoice, then this is more of a projection of sales, right? And this might be a pretty big guess at the beginning, and we'll talk a little bit more about being able to project things like that when we talk about budgeting here in just a little bit. However, we also need to just get a baseline of what our sales are expected to look like. And so that seasonal fluctuation is extremely important as well. And once we've been in business for a little while, we do have a better idea of what sales on June 24th, if we're tracking it as we should be, on June 24th should look like, or what June should look like, and then what July should look like. And that's what did we do last year? What can we reasonably expect? Are we running a sale? Maybe it's going to be higher because of some kind of marketing campaign we're running. So there's some factors that come into play. Product sales, contract revenue, and then there's that loan proceed part that I mentioned. If we are taking out a loan, those loans proceeds are obviously coming in. So just as a example here, our starting cash was $8,000. We have cash coming in. We're expecting to receive $12,000. So that puts us $20,000 in cash, right? And then we put in here, what's our cash going out? So examples of cash going out are all those expenses that we typically have. So that could be rent, payroll, our contractors, utilities, software, loan payments. And we're expecting this month for that to be around $10,000. So the ending cash, then we figure out based on those numbers. So we've got 8,000 to start with, 12,000 coming in. We take 10,000 away in expenses, and so we're going to have ending cash of $10,000. And then you can make decisions based off of that remaining $10,000, right? How much are we going to move in? Thing, because we now know that we can expect that throughout the month we have a $10,000 buffer there. So plan ahead, stay prepared, and protect your cash. That's really the most important thing here. So here's a simple example also. If we're looking further ahead than just 1 month. So even starting with the week ahead is super helpful, right? And we're going to look at what can happen with cash flow right here from month to month and why it's pretty important to start to look at it a little bit further out. And the reason being, maybe this business here has seasonal fluctuations. So we might be in the very beginning of the year, and month one might actually be January, February, March, April here. And so our revenue received is it's very low in January. So we are only going to be bringing in $5,000. But we have $40,000 in expenses that we know that we need to pay in January. And so that gives us a net cash of $35,000. Now, what I didn't put visibility in here is what maybe our starting balance in our bank account actually looks like. Hopefully we've got $35,000 or more in there, right? If we don't, then we're talking an owner equity infusion, right? We've got to put our own money in there, or we've got an operating line that supports that, or we're using credit card, all those other things that we might be using. But at least I could be sitting there on January 1 going, I'm got a $35,000 problem this month, or maybe I figured that out in December. And I already was able to make plans as opposed to I keep looking at my bank account hoping that money comes into it. And the expenses keep piling, right? That's the bad situation that none of us like to be in. Then month two, we've got a little bit of revenue coming in, less expenses, right? So now we're in a negative spot. But here we are 2 months into the year, and we're still $40,000 down. And so month three, then we know, okay, finally we're making up money, right? And we're finally making money. We might have been working throughout the winter, and it's just somebody finally paying us. This is what snow removal looks like for the northern, obviously, businesses that do snow removal. They work all winter long. They've already paid for all their salt. They've already paid all their labor, and people really don't start paying them until March or April or even May. So they finally get the money there. So there is a lot of cash flowing that has to happen within businesses like that. So you can see that net change over time. And cash flow really can swing dramatically. A lot of businesses will start to get on a sequence of they pay bills on certain days during the month, as opposed to paying the bills the minute they receive them. That's not cash flowing when you're doing things like that. Early in the season or early in the year, sometimes expenses are first, right? I mentioned that before, and revenue may actually arrive much later. So this is a weekly cash flow example, as I was mentioning. So week one, we have no cash coming in, but we need to pay $8,000 in payroll, rent, and supplies. Week two looks a little different. Vendor bills are due that week. Week three, customer invoices got paid, right? So we've got $12,000 finally coming in, but we do have cash going out. And then week four, we know we have payroll again, and then we have our loan payment. So we can really start to break down what we're going to pay and when. And you can also make decisions based on vendor bills of saying, okay, we're going to pay it this week instead of next week, even though it's not due till next week, just because we know the money, where the money is going to fall, right? And what we need to pay when. So you can kind of see on the graph if you're a visual person. I'm a very visual person, so I have to see graphs and things like that to help me understand where things are actually going to work out. Without that planning, though, that early gap could cause a lot of stress and force use of credit cards and things like that, or even emergency borrowing if I didn't actually have money in the bank and I had $8,000 in which I had to pay for payroll, rent, or supplies. So good cash flow planning obviously helps us cover our expenses, our debts, and take advantage of all those opportunities that I mentioned before, where we actually can make margin and make someone, or we're extending that credit. So those fluctuations in sales, right? If we're a cash at the point of sale type business. This again can show how cash flow can be impacted, right, between different weeks. I'm not really sure why I jumped from week 4 to week 6 there, but and maybe it took until week 6 for the money to actually come in. So cash is going out, cash is going out. We still don't have cash, still no cash, right? And then finally the cash comes in. So it took week 6 to be able to cover the expenses that actually started in week 1. And it creates a significant cash strain. So managing it is planning ahead. Big time, plan ahead, know when the cash will go out, when it will come in. Keep a cash reserve. That's also extremely important. So build that buffer and cover the gap. Negotiate the terms. So better payment terms with customers and vendors also help. So if you've got vendors that are requiring you to pay the moment that you purchase something, there are vendors out there, right, that will extend those different terms, the same as you might be extending those terms to your particular customers. So if you can have that little bit of leeway, that helps as well, for both sides. And then speeding up collections, invoicing quickly. Don't have the invoice just sitting on you that you haven't even sent it out yet, right? So that clock isn't ticking until you've actually sent it to them. I have seen that bottleneck be internally. The job gets done, it doesn't get invoiced, right? As long as something isn't getting invoiced, it isn't going to get paid. From that standpoint. And then use your financing wisely. So short-term financing can help bridge a gap when it's needed, but you definitely don't want to get into the world where you are having to use short-term loans. Certainly there's a lot of predatory loans out there. Credit cards definitely don't have the greatest interest rate, as long as you're able to pay those off quickly to bridge that gap. But you don't want to be in a situation where you've got to get money today, or something bad is going to happen. Profit doesn't pay the bills, cash does. So we can be a great profitable company on paper. And I hear this so many times. Oh my gosh, how did I have that much profit? Which means I also had to pay that much taxes. And I always feel like I have no money in the bank. So understanding your timing is going to help protect your cash flow. This is kind of what a cash flow, and by kind of, this is an example of what a cash flow statement looks like outside of my cute little AI animations. So we've got cash flow from operations, and it could be a number of these, right? This is positive money coming in as well as money going out, because so this is operational. I had mentioned before, once we start growing from a business standpoint, right, we might also have investing that's happening. So there's assets, investment income that could be in there, and then we've got cash flow from financing. So pretty standard cash flow statement. You'll see operations, investing, and financing, and all of these can have money coming in as well as money going out. So it's broken down like this, and then you would see that net cash flow then at the bottom, and that's that remaining number that I mentioned. There is a website down here at the bottom that just has a basic cash flow. This is where this came from, right? Where you can plug those numbers in. Now this is all manual, right? So it's already coming from information that you've already generated, as opposed to using software where you're plugging your numbers in there. So a weekly cash flow management routine is a great place to start. As I mentioned before, look at the week ahead. You can look at the month ahead. You can look at 2, 3, 4 months ahead. And once you start building it and you get yourself into the habit of it, you'll have greater visibility to it, right? And it becomes kind of an addiction to say, because once you see it and once you understand it, then you will start to rely on it. So you want to review your current bank balances, your expected deposits, your upcoming bills, and your payroll obligations. That's helping you understand where those numbers are coming from or where the money is going. Ask yourself, what is due next week? What cash do we expect? And are there any gaps, right? So what are we missing? And to adjust, if we had expected invoices to be received the week prior or 2 weeks prior, then we want to follow up on those. So really looking at our accounts receivable report and making those calls and saying, hey, when can we expect payment, is pretty daggone important from a cash flow standpoint. It also could help you make those adjustments in marketing from a sales perspective. If sales are down and not what you were needing, I guess is the thing to say, in order to cover your cash flow. And so it's also going to help you delay non-essential spending. So maybe you were going to buy things for the office or yourself or that boat, and you've decided maybe that's not the best time for me to do it right now, so I'm going to delay that. And then it also helps you prepare for those large expenses. So consistent weekly habits will help you build that cash confidence. And one of the most important things that I guess I should say is it helps get you away from looking at your bank balance. Now, it's important to look at your bank balance, but it's also important not to make strategic decisions based off of what that balance is, because that balance doesn't include all of this stuff that we're talking about right here. So, what cash flow challenge affects your business the most? That's going to be a poll question that I went ahead and dropped in there, so you should be able to see it now. Customers paying late, not knowing your future cash needs, unexpected expenses, seasonal ups and downs, managing payroll and bills. So quite a few different things that you can choose. You can choose multiple things in there as well. What challenges that you're currently having with your business. So I'll let that poll go ahead and stay open. You can continue. And we are going to move right into budgeting. Remember, the Q&A is open in case you have any questions. You can drop them in there and I will see them. So cash flow and a budget are two different things, which is why we're talking are the next level to managing the financials of your business. There's multiple tiers owners will go through if you've never maintained finances before or you don't understand financial statements. So most businesses, when they're starting out, when they don't understand, they start to learn the basics of how to categorize things, to put them into different buckets, right? To say if it was sales or if it's a loan payment or if it's an expense that's office or if it's a direct expense, these types of things. So you start learning those terms, you start learning your assets, your liabilities, your equity, your income and expenses. And you then start to get to where things are building into your financial statements. So you're starting to develop a profit and loss in your balance sheet and you're starting to look at those. So that's like level 2, right? So we've gotten things started to get organized, then we hit the next level and that's where we start to understand how those numbers are being developed into those financial reports and what those financial reports are telling us. So we start looking at those reports and we get higher levels of questions, right? That we're speaking to our bookkeeper, our accountant, our consultant, whomever it may be, so that we can start making decisions based on that. And then we hit this level. And in this level, we are really starting starting to dig into cash flow because we understand what the profit and loss is telling us, but we didn't have that visibility to what's going forward, right? And so, and then we start developing a budget, which is basically a forecast that we're trying to look forward or trying to understand what the year should look like, or what we want the year to look like. I had a question that says, what's the best free or cheap software for financials and startups? There's quite a few tools that are out there. Google Docs or Google Sheets is one of them that's free. It's not great. It at least helps you get started to help you get organized. They actually have a financial statement template that's already built. Free, you can step into something called Wave. There is an add-on to that that has a subscription expense. There's always QuickBooks. The thing with QuickBooks is it's a little bit more flexible and it's a little more scalable. Not a little more, it's a whole lot more scalable than something like Wave. But there are a few tools and things out there that are free or cheap. I do like to say though, your finances are one of the places where you don't want to skimp and try to save money. It's amazing that it's like one of the things that everybody tries to save money on the most, but it also can make or break your business, or it can hold you back a little bit. So consider all of those things when you're making decisions about how you manage and maintain your finances. So simple definition, a budget is spending and revenue plan for your business. So that's exactly what it is. It's a plan. It's you saying, I think we're going to sell this much this year, and I think we're going to spend this much this year, and we're going to have this much profit. And it's looking forward at it, and it's saying this is what we're going to go for, right? What do I expect to earn? What do I expect to spend? Can I afford new expenses? So if I decided that I'm going to add something new in the next year, I'm going to buy something, I'm going to put that into my budget so I have visibility to that. And how much revenue do I need in order to pay all that money that's going out, right? Whatever that may be. So if we're planning today, we spend wisely, we grow tomorrow. That's why that's different than cash flow, because cash flow, things are already happening, right? And it's helping me decide if I can buy something. The budget is that plan that tells me what I thought I was going to do, or what I'm anticipating that I'm going to do as my business grows and changes. I'm going to go ahead and share that poll with you so you can see what everybody was saying in there. Looks like we're pretty much all over the place. I mean, as far as we've all got these challenges, right? And then the seasonal ups and downs are definitely a challenge that a lot more of you are experiencing. Financial statements versus a budget. So this is the difference between those financial statements and the budget. So financial statements look backwards. They show what already happened, right? We can't change what already did. And they measure that past performance. They're awesome because that helps us make decisions for the future. And it's extremely important that we have them. However, it is a backwards looking item. A budget then looks forward, very much like a cash flow, right? But it's looking forward. It's an estimate, though, of what may happen, and then it's a guide for those future decisions. So they're both essential, and they drive a stronger business. So we really do need both. Now, I know in businesses that I've been in, especially in the small business world, and it feels like because things are pretty volatile most of the time, especially if we're starting out, budgets right? If it's not in the budget. Now, guideline, it's parameters. There are some businesses though that say that you cannot spend money if it's not in that budget, right? And that's how they're managed. I got a note that I'm breaking up every so often. I might shut my video off and see if that helps. Let me know if that continues to be a problem. It could just be where my Wi-Fi is right now. So the difference between cash flow and a budget is that cash flow tracks the timing of the money, as we mentioned, right? Cash flow is all about timing. It also focuses on the bank balance, at least the ones that we're looking at. It can be a weekly focus. It should be. And it helps prevent those cash shortages. Now, a budget That helps us plan our revenue and expenses. It focuses on our business goals. It's monthly focused. It may even only be quarterly focused. It depends on how often you're going to look at it, but it really does help you guide that decision making throughout the year. So cash flow tells us if we can pay our bills. Budgeting tells us where the money should go in the future. So big difference between those two, even though they're both forward looking. So starting a simple budget. How do we start a budget if we've never started one before? The easiest way to build a budget is to start with real data. So if you were one of those businesses that said you were in growth, right? You've already got data probably from the prior year in which you can look at and start to make these decisions. If you don't have that, so if you're pre-venture or your startup, you probably, if you haven't, you should do financial projections or do business planning. And there's lots of great resources out there to help you with that. So you would take, in order to do this the simplest way, and I'll show you how to do this if you don't have the opportunity or the option of using a prior profit and loss or tax return either. So you're going to use the most recent data that you have of business are available. And as it mentions there, if you're starting a new business, use realistic projections. And then you're going to review the revenue trends. So you're going to look at monthly or yearly revenue. Now, if your projections are for the year, so say you're just starting out, your projections say it's going to be $100,000 for the whole year. What I would do to simplify things is just divide that by 12 and drop that equal number into every month. So that gives you a baseline to start with, right? So you say every single month I'm going to sell this much money, right? And you may or may not do that when you're first starting out. That's where those seasonal fluctuations come into play. So if you definitely know you don't sell anything in January or February or June or July or whatever that may be, then you can adjust those numbers, right? But if you're saying, yep, I sold $100,000 last year, I think I'm going to do exactly the same this year. That's how I'm going to break up my budget. And then I would take the expenses and I would do the exact same thing. And I would divide those by 12 also, and then I would make adjustments from there. If you have already profit and losses built from the prior year and you could see it from month to month, so if you're using a software like QuickBooks or one of those, you can see every month, as long as you've been putting your money in, or you've been categorizing everything and you've been reconciling your accounts. You can see it. Then you can build the budget off of that prior history as well. Now, most of us, especially even if we're pre-venture startup or growth, right? It's not our goal to be the same size year after year. Typically, we are all growing in some capacity. So maybe our first year of startup, we only sold 20,000, but we're going to be 120,000 next year, right? So you would set your budget based off of that. Now, expenses don't always follow revenue, so they're not one-to-one, right? So we grew $100,000 more. It doesn't necessarily mean our expenses are going to be $100,000 more. So there is a little bit of understanding maybe of what our expenses look like and things that are going to cost us, that we would want to work with those numbers within the budget in order to get that. But we're going to review those major expense categories and analyze where the money is being spent or where the money is going to be spent. And we're going to focus on the biggest expense categories. So we don't necessarily have to focus on every single line item. I have, however, been involved in companies that have 30 tab budgets that are built on spreadsheets, because they are that meticulous in the amount of time and energy that they put into their budget. And then those are the types of companies that stick to it very solidly. Just went out the door, right? So there, we can't predict everything with our budget, but we can certainly try. And then we want to be realistic and also conservative. And so we're going to talk about high, moderate, as well as conservative budgets. So a lot of people will actually have 3 budgets, so that we can plan for that as well. And then we want to estimate the coming year. So we build that budget used on our findings. We create monthly or quarterly estimates for the year ahead. So a good budget isn't just a guess, even though I said a little bit that we're guessing in the beginning when we haven't done it before. It's a plan based on what's real. So we want to start with those facts and then plan with confidence. So here's an example structure of using the prior year data. So last year, our revenue was 180,000. Cost of goods sold was 70,000. Gross profits 110. Operating expenses 90. Our profit was 20,000. So we're budgeting then to increase our revenue by $20,000. That's going to drive our cost of goods sold up by $10,000. Our gross profit is going to be 120,000. Our operating expenses are going to be at 95,000. Our net profit then is going to be 25,000. So one fun thing about budgeting, and when we run these numbers, I've been in businesses before that's like, we just need to increase sales. We need to increase sales, and sales keep going up, and sales keep going up, and profit keeps going down, right? So we've got a cost of goods as well as our overhead and all of that problem, right? So more sales does not always equate to more profit. And sometimes we can see that when we're budgeting. So we often hit a sweet spot. And there tends to be a internal change that needs to happen within our business, right? And that might be a new system needs to be involved, right, to help lower some of that cost, different personnel, right, that type of thing. And so budgeting is one of those times where you can start to see visibility to those things. So examples of changes: price increases, rising supply, new employees, new products or services. So the prior year results are the foundation, and then we build that realistic, achievable. Right? So we want to have a revenue number. We want to have fixed expenses. So that's things like rent, software, insurance, internet. These are predictable every single month. They cost the exact same amount, right? That's why they're called fixed. And then we have variable. So these are supplies, marketing, fuels, subcontractors. These variable ones are also the ones that really kill us with cash flow too, because they're not as predictable. Because the amount can be different every single month or every single week. Certainly with fuel prices lately, right? We've seen that. And then owners pay. So don't forget to put yourself in there, and decide that you are part of your budget. If you don't budget to pay you, you won't pay you, because then it becomes something that's an afterthought, right? So it's always best to budget yourself in there, even if cash flow doesn't allow for it at the time. At least you've put yourself as the budget. And then we've got savings and taxes too. So we should be saving something. We also need to make sure that we budget for taxes. So plan smart, spend wisely, grow your business. So with that simple budget, if we're starting out the first time, we've never seen this, we're going to estimate our monthly revenue, list out those fixed expenses, then estimate our variable expenses, set aside money for taxes, emergency reserves, future investments, and then we're going to review monthly. This is the big part of a budget. I've had companies that have built the most beautiful budget, then they never look at it. One of the great things about something like a QuickBooks or Xero or one of those other softwares is that when you are putting your information in there every month and you're building that profit and loss, you can actually do a budget in them as well. Most of those and then monthly you look at a comparison of budget versus actual. That budget versus actual is extremely powerful because you're able to say, this is what I thought I was going to sell. This is what I was going to thought I was going to spend, and this is what I actually did, right? And I like to look at it as a red, yellow, green situation. So if I was in line with what I said I was going to do, it's green, in my opinion. And I might drop this into a spreadsheet and actually change the color of something. So this is green. If it isn't, or it was close, then it gets yellow. If it's not that at all, it's red. Now, that doesn't mean that I'm necessarily going to make massive decisions for the next month, It just means maybe I'm overspending in one category compared to what I expected to spend, and then I have to look and say, well, am I underspending somewhere else? And generally there's a reason for that, right? And so we want to ask ourselves the question, like, why did I overspend here? That might have been that inventory purchasing that I was talking about with cash flow, right? I decided to go ahead and spend more at the beginning of the year than I anticipated that I was going to spend at the end of the year. And really, from a budget standpoint, as long as it works out by the end of the year, then I was on track with what I thought I was going to do. Definitely supply expenses could go up, but other expenses could go down as well. But it's really helping me monitor and track what I thought was going to happen throughout the year. Here is a target way to look at these things as well, and this could be in percentages. So a common small business target, cost of goods sold, a typical target for a small business is somewhere between 30 and 50%. Your overhead and operating expenses generally fall between 30 and 40% if you have a target profit of 10 to 20%. So if you don't know what numbers to put in there, you can start looking at it as percentages. Cost of goods sold, if you don't know what those are your materials, your direct labors, your product costs, your production inputs. Basically, cost of goods sold are those expenses that produce your sales. So they're directly related to the revenue that you receive. Overhead, everything else, that's a cost of doing business. So that's your rent, your marketing, your insurance, admin, payroll, software. And then we've got profit. So this is where profit, your owner's compensation actually comes into play, retained earnings, reinvestment, or your ability to reinvest. So they're percentages. They're not exact rules, but they do provide you a really good, healthy starting point. This is a example of what those percentages then look like if you were to plug numbers into them. So revenue is $100,000, so 40% of that, our cost of goods sold would be 40,000, our overhead would be 35,000, and our profit would be 25,000. That is the simplest form of a budget that you could possibly get right there. And then you can divide all those numbers by 12, right? And then you could start comparing your monthly actuals against that to see if that worked out, right? It just helps you plan, track, and grow and stay sustainable. Now, in every industry is different as far as these percentages are, and these are industry budget benchmarks. Now, you can do your own research, right? If your industry is not up here, but generally industry standards, you probably have heard that phrase, do follow along with some type of target where they may be. So if you're up at the top of this list with professional services, they have very little cost of goods sold, right? They have very little inputs that are actually going into it. So the majority of their expenses are actually overhead expenses. So you can see how those will alter and change there. And then we've got our profit target. And then we go down through trades, construction, retail, right? Those are restaurants have very high cost of goods sold because they have a lot of supplies that they're purchasing, right? The food itself. And they also tend to have lower profits. And then we've got agriculture. For yours specifically, it will give you some kind of benchmarking detail in which you could start out with, as well as Google. So these are not necessarily a rule. These are just basic industry standard type things. So when we talk about budget versus actual, this is where it becomes powerful that you can compare to the reality. So are my sales meeting my expectations? Are the costs higher than they were planned? Are the margins changing? So January, our budget was 15,000, our actual was 12, so we're behind. See how it turned red? February, 15%, actual revenue was 18. The difference, we're positive, right? So we actually oversold, which is, a great place to be, right? It's not about being perfect, but it's about learning from those numbers and adjusting. And the more that you do this and the more that you understand your business and the more as your business grows, things will become more predictable from a budget standpoint. And that's when you can really start deciding, I'm going to buy pieces of equipment, I'm going to buy a building, I'm going to add employees, right? I get that question a lot. How do I know when I can hire someone? That's a very business specific question. And it's always looking at the numbers. How are we budgeted? Can we include the payroll, them as part of payroll, right? And so then we're looking at cash flow. Is that part of the overall cash flow that we're able to handle? So conservative versus high. So I mentioned when you're adding budgets, we can have multiple types of budgets. And it's very common to have three of them, right? So are we going to have a high growth? And we're going to set off that what's a more realistic and what's a conservative. And so I usually recommend when you're setting your budget to stay as conservative as possible. It is always fun to do the high growth one. I was in a business one time where the owner wanted to buy an airplane. And so the CFO and I sat there and really worked on a budget where we could budget in an airplane to be purchased in the next year. And so obviously that was going to affect the sales team because growth was going to be needed in order to do that, as well as it was going to affect the operations team because their margin expectations and things like that were going to change, all to be able to buy an airplane. Happens to also be the same person that bought a boat. So why multiple scenarios? Because it builds that financial resilience. It improves decision making. It prepares you for that change, and it helps keep your goals in focus. So use the conservative to stay safe, but expected to stay on track. That's really the thing with that. So conservative, there's just a screen about it of why a lot of businesses end up using the conservative side of things. Is that obviously you don't want to budget and not meet that revenue. I have been in that situation before where the owner said, nope, we have to hit this revenue. Knew darn well the sales team wasn't going to do it. Also happened to be during COVID. Guess what? We missed revenue, which means we missed the budget, and it was a disaster. What budget helps you decide? Can we afford to hire? I mentioned that before. Can we raise wages? That's another one. Can we pay our employees more? Can we offer them more benefits? Can we give them bonuses? This is a great thing a budget will be able to help tell you that. Can we invest in new equipment? Do we need to raise our prices? So is our revenue behind because our prices aren't high enough, or do we just need to sell more units? That type of thing. And how much cash reserve see your options, understand your impact, and make those confident decisions. Common budgeting mistakes, though, guessing instead of using financial data. So there is enough financial information out there, probably based on the type of company that you are, that you could find those percentages. Even though there's a couple questions I have in here about percentages, remember those are just what I pulled off the internet. That is no guarantee that they are accurate. It's just a starting point, but certainly do your own research before you develop that. Definitely in the profitability world, I know the one question is one of the profits seemed very high. You'd be amazed what you can do when you start budgeting and you get into the business scheme of things, of what types of profits you can actually achieve. Now, I'm not saying that that's realistic in every industry, though. Ignoring seasonal revenue patterns. I saw you guys all talking about seasonal ups and downs, right? Those revenue patterns can really change the way that your budget looks, and also from a cash flow standpoint. Forgetting irregular expenses. There are often irregular expenses that pop up out there. Annual fees, daggone it. Those things will get us, when you thought, oh shoot, I didn't realize I had to pay that in July or August. I know in our company we have tech expenses. Those often hit right at the beginning of the year, and so Zoom, for one, that we're on today, that is pretty expensive to purchase Zoom webinars, and Google expenses, and also our CRM expenses, and they all seem to hit right at the exact same time, and so that can do fun things for budgeting as well as cash flowing. And then also not reviewing that budget regularly. So just make sure that you're looking at it, you're making those comparisons, and then you're able to ask questions. So best practices: review your budget monthly or quarterly. Monthly is best, quarterly is fine, right? Do it more than just once a year. And when you review it regularly, it really helps you stay in control and catch those issues early to make those better decisions. And you want to know, are you on track? Compare your actual with your budgeted. Um, are we meeting our goals? What has changed? Are we watching things stay red month after month? Why are we overspending in one category and not another? And do you need to adjust? You can always adjust. I was in a company that always set a budget. For January, we started out and we had a thing in July called rebudget. And rebudget was never a beautiful time of year, just at the it could be a beautiful time of year, though. It depended on how the business was doing, right? Because rebudget either says we're behind in revenue, over in expenses, and people lost their jobs, unfortunately, in this business. Or we're ahead on revenue, we're doing great. Guess what? We get to hire more. But they waited until July every year. So they did a 2-year comparison to make that decision. So it was January and July. And from a management standpoint, you basically just stayed status quo between those time periods. I prefer to look at things a little more often, maybe not rebudget, right? Maybe rebudget makes sense one time of year, but you definitely don't want to go along with a we're high growth budget and we're really behind, and that's definitely how you can have cash flow issues. For sure. So the budget's not set in stone. It's just a living tool that you're supposed to be looking at and making changes. So what is the first action that you will take after today's workshop? Let me pop that one up there so you can all answer it. And then remember the Q&A is open. We've got like 1 minute. I'll be around for a couple more minutes. If anybody else wants to drop a question in there, so that I can go ahead and answer it live for you while we're here. But hopefully you guys have a couple more tools. I'm also, with the end of this, you might want to know, which this is typical question, is this recorded? Yes, it's recorded. Also, the slides are available as well. And so I will be sending out the recording link to everybody that registered for the workshop, as well as a spreadsheet. If Eventbrite will let me send it out, that is basic tools for cash flow planning as well as budgeting. And the recording is available there as well. You can get a copy of things from Community Ventures, so please reach out to Lou and his team at Community Ventures if you need a copy of any of these things and they are not available to you. So that is your option there. And it looks like you guys are going to make some great changes with your businesses. So some are going to be starting to create cash flow. Some are building a budget, reviewing expenses. Yeah, that's a great place to start. And then also scheduling those regular financial reviews are awesome. Everybody that is thanking me in the question and answers, you are most welcome. And yes, so Ella asked, can you share any examples of financial projection tools? I do have a spreadsheet that's just got some checklists and things in it. And it's very basic on the surface, right? But certainly there are many tools and templates that are out there that can help you with financial projections as well as AI. Always an option. Yep. All right. If it looks like also interested in financial projections. Yep. So I will try to share some more information with you in that follow-up that you guys will receive from Eventbrite. And definitely working with Community Ventures is the way to go. That's the link I was going to provide you all. So thank you to Community Ventures for offering this workshop to all of certainly you can follow up with them. And I actually, in my next slide, have their website on there. So it's cvky.org.
Thank you, Christy.
You're welcome, Lou. Thank you. That's Lou from Community Ventures, everyone.
Yeah.
All right, I'm going to go ahead and sign off. But thank you all for joining us today.